What's up YouTube? It's Carlo here, and in today's video I'm gonna go over what I do to analyze stock in which I choose to hold for long term. So what am I specifically talking about? I'm talking about fundamental analysis. So before we dive deep into it, this video is sponsored by Webull, and it's a free brokerage to trade and buy and sell stocks, ETFs, bonds, you name it, even cryptocurrency. But you could get 4 free stock valued from $100 to $1,200, and once you open up an account with $100, you can get these 4 free stocks. So make sure you check the link in the description down below, and also make sure you hit that like and that subscribe button. But what is fundamental analysis? Basically, fundamental analysis of a stock examines the company through its management, its structure, the competitors within that industry, and the growth rate, the growth potential of future earnings, and revenues. So think about more like profit loss statements, balance sheets, to determine if that stock, that company is a good value, or is it at fair market value. And basically thinking of it as more like, what is the true intrinsic value of a company. So diving right into it, there are two types of fundamental analysis. One is quantitative analysis, and the second is qualitative analysis. So starting off with number one, quantitative analysis, it is something that is measurable, something that you could calculate, something that you could count and crunch the numbers on. So it uses inputs such as profit margins, debt ratios, PE ratios, book value, and like I said, you could calculate it. You could type in, get the information on the quarterly statements, and determine if this stock that you wanted to invest long term in, is it a fair value, and eventually forecast its future earnings growth. Number two is qualitative analysis. So it's totally different than quantitative. So qualitative analysis is something that you cannot measure. Qualitative analysis, on the other hand, deals with intangibles such as inexact concerns that belong with social and experimental realm rather than mathematical. Like I said, you cannot measure this. And it has different associations such as the brand, the management's trustworthiness, the customer satisfaction of this company. What is this stock's company's competitive advantage? What is its economic moat? And how is this company adapting to the current environment that it is in? So before I dive into everything, I'm gonna go over what I like to do. When I go over my fundamental analysis. There's so many things you could analyze, but there are 6 things that I like to do to help me choose whether I should invest in a company or not. So what are the 6 things that I'm talking about in regards to what I look at in determining whether I should invest in a stock or not? One is the company increasing its revenues quarterly and yearly, year over year? So what do I mean by increasing revenue? It's basically the revenue is the total amount the company generates by the sale of its goods or services related to the company's operations. Number two is the company increasing its cash flow quarterly and year over year. So what do I mean by increasing its cash flow? So increasing its cash flow is the cash flow from its operations minus the total CapEx, so capital expenditures, things like salary, cost of inventory, so all the costs. So basically think of it like this: the money that they make minus all the expenses in running the company. What is that left over free cash flow that they can use to pay their debts, or even use that cash flow to do technology, do research and development, and things like that? The third one is there a the third one is there a stable return on equity? So what do I mean by that? How much money is the company generating for its investors? You and me, divided by its net income. So definitely they call it ROE, return on equity. So that's a really, really big one that I like to look at. So you as an investor, when you put money into the company, obviously you want that money to grow. And is this company returning money to you as the investor? They better. Number 4 is, do they have conservative debt? What do I mean by that? Are they too over leveraged in different avenues? So say for example, let's say company X is in the telecoms industry. Are they trying to do phones? Are they trying to do internet? Are they trying to do streaming, online streaming? Are they trying to get into apps? Are they trying to get into autonomous vehicles? As you could see, that's too many things that they're into. But in regards to that, you don't want to have a company that's too over leveraged and has too much debt. And if they have too much debt, that is a red flag for you as an investor, or something to look into. So basically, them having too much debt shows you, the investor, that they don't really know how to manage their financials, which should be a red flag for you. And a little bit of debt is good because you want to make sure that the company that you are investing in is spending money to make more money, such as research and development. Number 5 is, do they have an economic moat? What is an economic moat? It's a distinct advantage a company has over its competitors, which allows it to protect its market share and profitability. So think of, kind of say, like brand awareness. Brand awareness is something that is an economic moat. Would you rather invest in a company that is well known worldwide versus an up and coming fashion product line? Would you want to invest in Nike, or would you want to invest in Mr. Joe Schmoes? Obviously, you want to go with a person that is worldwide, that everyone uses, everyone wears, everyone sees. It's part of the culture, So that's what I mean by economic moat. And it's often an advantage to replicate or mimic this type of brand or their patents. And this basically creates an effective barrier to help fend off different competitors. So that's what I mean by economic moat. And number 6 is its management. And number 6 is the management style. Management style, basically, who is the CEO, CFO, and the whole team that's behind that company? Are they running the company efficiently? Are they growing? Do they have bright, smart, brilliant minds that are helping move the company further on within the future? Those are things to definitely look at. And those are my top 6 things that I look at when I do my fundamental analysis. So let's dive into it right now. I'm going to go over one of the most popular stocks that everybody knows about. So today we're going to be doing a fundamental analysis over Tesla. So let's dive into it right now. Criteria number 1 is the revenue increasing year over year? So if you go to number 1, go to morningstar.com. From there, you'll click on financials, and from financials, it'll break it down. So let's go to income statement, revenue, 2017, 2018, 2019. As you could see, the 3-year trend, Tesla is increasing their revenues year over year, which is good. And if you see the chart to the right, is going up, which is good. Number 2, net income. So basically for net income, it is specifically, so if you see for a business, net income is the amount of revenue left after subtracting all expenses, taxes, and costs. So let's go to net income. Net income is one below or two below right under revenue, so net income. So comparing it year over year. So in 2017, they're at negative 1.96. So they're operating at a loss. At 2018, it's a smaller loss. And in 2019, it's a smaller loss. And then as of 2020, it is positive. So they are profitable. And that is another check in our box. The next third criteria is free cash flow increasing year over year? So free cash flow is basically cash left over a company after it pays its operating expenses and its capital expenditures. So let's see. Oh, all right. So we'll go all the way down to cash flow. And let's see, free cash flow is the one all the way at the bottom. So free cash flow, so comparing within the last 3-4 years, 2017 they're at a negative, 2018 it's much smaller, and then 2019 they have 0.97. So year over year the free cash flow is increasing. So basically free cash flow, they're able to pay off their debts and use that cash flow, that income that they have, to invest in other avenues. So whether it be batteries, a new plant in Texas, or more research and development, AI, and focusing on in autonomous vehicles. Woo! Next one is Tesla as a company, what is its ROE? ROE is return on equity. So basically return on equity is the money that investors put into Tesla. Are they being profitable and returning the money and increasing that money that they have with their investors? So let's go to the top. So profitability. So return on assets, and then one over is return on equity. So their return on equity is around 5.04%, which checks it is not negative, which is what we want. So their return on equity is definitely growing. So that checks the check mark. And the next part is how much debt does the company have? So if you look to the left on financial health, go to the fourth one, debt to equity. What's their debt to equity ratio? It is kind of high. So it's 0.95. So pretty much you want companies to have less than 1, because if their debt is equal to the equity, then that's a red flag. If they're not able to pay their debt, that's a red flag. But their debt is less than the equity that they have. But pretty much the key thing that I want you guys to learn here is we ideally want the debt to equity ratio less than 1. But a little bit of debt is good, because that means that they are investing their money into other avenues. Like I said, autonomous vehicles, lasers, what else? As well as their batteries, out doing it in-house as opposed to outsourcing it. So definitely that's going to create debt for them to actually build those things. And moving on to the next one is, does Tesla as a company have an economic moat? So economic moat, as I was telling you earlier, is, do they have brand awareness? Check. Are they the leading industry leader for electric vehicles? I would say yes. If you see the competitors, NIO, XPeng, Li Autos, and then within the US as well. But who is a beast in the game? Obviously, it's Tesla. They're already making power plants in Texas. They're already doing battery day, where they are trying to make their own batteries as opposed to outsourcing it to China, and then from China to Japan, and from Japan to here. So that's definitely going to cut the cost down. Does it have an economic moat? Yes, in my opinion, I would say so. Last thing is the management doing a good job? Me personally, I think Elon Musk is our renaissance man of this century. So electric vehicles, we're definitely going into more renewable energies. He already has SpaceX. He already has the sunroof, Tesla Power, as well as many other ventures that he's going into. But at the end of the day, Tesla is the beast of the electric vehicle market, and they are improving their batteries, they're improving their vehicles, they're making it more cost effective. And if you look at the research of how is putting a lot of his own money into the company, so he has skin in the game and he has a lot of great minds behind him. So as a management, I would say Tesla hits another check mark in the book. But I really hope you guys enjoyed this video. Hope you guys learned something as well. If you guys got something from it, make sure you hit that like, you hit that subscribe, and definitely go check out the Webull link down below. So I'll see you guys on the next one, and I much love and appreciate it. Peace.